All right, good afternoon, everyone. I think we're going to go ahead and get started now that it's noon, and I'm sure more people will join as we get going. We want to welcome you to our first ever Ranch Capital webinar, and we appreciate you taking the time out of your day to engage with us. Our topic of discussion is titled 2021 Key Views and the Reopening Trade. So we're going to be reviewing what happened in 2020 and then how that translates into our investment strategy for 2021. And then we're also going to go through and give you some background on the 5 factors that support the reopening trade. And during our discussion, we'll answer questions along the way, but we'll also save some time at the end as well to be able to answer any additional questions. And our fearless leader, Greg Pacitti, and our Chief Investment Officer, Brad Tremitier, will be our wonderful hosts for our discussion today. And just as a reminder before we get started, just a few compliance points I need to make before we move on. The opinions expressed today are based on current market conditions and they're subject to change. We do our best and believe the information obtained for this presentation comes from reliable sources. Also, this presentation is for informational purposes only, and it should be viewed as educational and not be considered investment advice. So now that that's out of the way, let's get started, and I'm going to hand it off to Greg to begin.
Everybody, sorry about that technical difficulty. So now we're going to get started. So I'm going to give you the real short version. So if you're stuck for time and you want to, not able to stick with us for the 30-40 minutes that we're going to be speaking, we're going to start out with just a quick overview of what we're thinking and some of the themes that we're bringing into this year, which a lot are carrying over from the previous year, last year. So last year in 2020, the macroeconomic theme was policymakers versus COVID-19. It's amazing how the stock market came back as much as it did. The policymakers and the stimulus and the movement by the Fed, by Congress, by the president, all of that was enough to really overcome all the challenges that COVID-19 presented financially. And the thing with 2021 is that you still have the massive stimulus that was put in last year is going to carry over to this year. I mean, trillions of dollars that was put into the liquidity into the markets, and you can expect even more liquidity to be put in. And this time, we're going to start opening up for business. For last year, for most of the year, a lot of businesses were shut down. So the vaccines are coming, right? And Biden has a pretty high objective of getting over 100 million vaccinations put out in the next 100 days. And so as an investor, we're always looking at what's next. So currently, we're still dealing with heavy cases of COVID-19. And that's going to continue for a while. But if we start looking 6 months from now, and if you start imagining what's going to happen when you get 100 million, 150 million, if that ends up being the case, of people vaccinated, and we have less worry about what's going on with travel and business. All this pent-up demand is going to just, explode into the economy. And on top of that, you're going to have a lot of extra stimulus because the policymakers are going to err on the more aggressive side and then the more conservative side. Already Biden has come out with a $1.9 trillion proposal. They're going to do everything they can to promote lending, to promote liquidity, to promote, help businesses that are struggling. So it's an all-out, even more than a bazooka, it's more like a tank effort. And all of that is going to translate into higher prices, probably, lead to, some inflation. It will lead to higher prices across the board, including stock prices. So equities should continue to generate positive returns. And we think that they could even end up being similar to this year, even more in the double-digit range. What will be different this year from last year is that last year was the year of technology, right? The NASDAQ crushed all the other indexes because most people realized, well, a lot of technology is pretty much exempt from COVID, right? We rely on technology no matter what we're doing in our lives. And so a lot of money initially went into technology stocks and growth stocks, and your traditional value types of companies, traditional dividend paying types of stocks were, made some money, but not nearly what the rest of technology did. Now, technology makes up the largest chunk of the S&P 500, so that also pulled the S&P 500 up last year. But we think this year, although we still love tech, we still think tech will do well because tech is in a long-term 10-year bullish trend. It's already been in a 10-year bullish trend. We think the stock market has another 10 years to run. Most long-term bull markets tend to last 20 years. So we think we're only halfway through this bull market. And of course, COVID, when it came out, was something from left field that nobody really saw was coming. But the policy responses have been so huge that it, helped the stock market and confidence that, going forward that we're going to get through this and then we'll get back to, business as normal. I'm going to say a new normal because a lot of things have changed. So how on earth did we recover from a 34% drop last year? If you recall, it was a very scary time. The market lost 34% rather quickly from February 19th all the way down to March 23rd, marked the bottom. And then it just had one of the most incredible rallies in a short period of time. And the S&P ended up in the high in teens last year for a total return. The NASDAQ was even more than that. So it was really just an amazing run. A lot of people were scared out here, understandably. But once the Fed starts coming in, once Congress starts moving in, those really outweigh so many other things when you are investing, because it all really comes down to liquidity, a certain amount of money chasing prices. And they made sure that there was enough liquidity in the markets to push prices a lot higher. So there was really three different things that pushed the stock market back. One was stimulus. There was 4 different stimulus packages last year that translated into roughly $3.1 trillion. It was one of the largest stimulus years in the history of the United States. Actually, the largest. A lot of money has been put in the system. And even when the Congress is stimulating, typically it doesn't just immediately move into the economy. There's typically a lag period of 6 to 9 months. So this stimulus that was put out last year is going to continue. The hangover from that, like the benefits from that, are going to continue into 2021. So you already have some stimulus that's left over that's going to be pushing prices up. To put that in perspective, when the last crisis we had in 2008, 2010, when the government started helping out, the percentage of stimulus versus GDP was, around like maybe 6%. Last year, it was almost 16%. So you can see it was so much more stimulus. And, in 2008, 2009, 2010, it was enough to pull us out of, one of the worst crises in history, that we experienced, and the stock market has rallied ever since. So that response was needed at the time, and it was enough. And now we've almost quadrupled that amount in the amount of response from the our government. You also have the Fed. This is the other part. The Fed in March 15th, they cut interest rates all the way to 0. And what that did is it promoted borrowing. It promotes the cost of paying back debt has really decreased. They started buying, they did $2 trillion of quantitative easing, where they're buying bonds and they're buying mortgages and they're pushing mortgage rates down, which is why you've seen the real estate market really take off. They encouraged direct lending. They issued PPP loans to small businesses and they changed it that you don't even have to pay that money back and it's tax-free. They're coming out with another round of PPP that started that process already. So they also pulled out their tanks as well. So not only you have the federal government in Congress, but you also have the Fed, who is also doing everything they can, and they can do even more. And they've made it very clear. All their statements say that they're in no hurry to raise interest rates, probably for another couple of years. And they want to see inflation tick up. They want to see it get above their 2 to 2.5% kind of guideline. So they want to actually get it to 3.5% so that it settles back down to 2%. It's very difficult to get it right at 2 or 2.5. So they are now determined that they're going to overstimulate, overhelp, and then hopefully that inflation will settle back down. But they're basically telling us we're not going to stop until we have inflation. And then the third thing that helped us get through with the market rebounded so much was technology. The innovation that's going on right now has just been exponentially increased because of COVID. So probably 5-10 years in advance now, because of the adaptation that people need to do to cope with COVID. I mean, imagine if we had COVID 15-20 years ago. No way would we be in such a great shape as we are today. And that's things like Zoom, which we're using today, cloud storage, online shopping, being able to meet people remote. It just, technology in our view has become the new blue chip stocks that your mother and father owned years ago when they used, buy like oil stocks. Technology is now that, should be that staple in everybody's portfolio, and probably should make up at least half of your portfolio, because most of the earnings that are coming from the S&P 500 is all from technology. We call it the innovation economy. We are in the midst of this boom. In addition to biotechnology, how fast that we dealt with COVID and coming out with vaccines from multiple companies is just astounding, and really in less than 1 year. And technology has actually helped biotechnology with that, because they're using artificial intelligence, they're using big data, the companies are speaking to each other much quicker. We've got 5G rolling out. So the combination of those two sectors, in our view, was one of the saviors of the economy. And that trend should not change anytime soon. It's only going to get faster and faster and faster, especially with the rollout of 5G. So we expect that the stock market is going to have a good year. We're calling it the reopening trade. We think there's a lot of pent-up demand, and we think that this is a fantastic time to be an investor. Like we're telling, positioning our own money this way, we're telling our clients, our friends, is like, this is the time when you want to take advantage of such an opportunity, because all the things are in place with the Fed, with stimulus, with the reopening. And I know it's sometimes scary because we're still dealing with with COVID, but as an investor, you have to look out past that. And that's what the stock market does, is looking out 6 months or to a year. So I want to bring it back to our chief investment strategist. Brad is wearing a very handsome bow tie today.
Yes,
I've never seen him do that for such a special occasion. And he's going to go over with you the 5 factors which support that reopening trade here in 2021.
Thanks, Greg. You're the best as always. And hopefully next time I'll get you a bow tie to wear as well. We've picked out 5 factors that we think will support, the market as a whole, which, is a judge of the economy as we begin to hopefully reopen throughout the course of the year. So on the first slide, what we're going to see is that over the last year, because of all the shutdowns that took place and people just not doing as much, there was a massive increase in the U.S. savings rate. So much so that we've added about 1.3 trillion in savings over the last year, and we're still, as of the end of the year, running a very large personal savings rate relative to our historical averages. So this money wants to be spent. When things start to open up and people can start to participate more in the economy, whether it's through leisure activities, purchasing different products, this money's gonna be, I guess we can say, repatriated back into our economy out of people's checking accounts. So on top of all the stimulus that we've received so far, there's a massive amount of cash that will be coming into our economy through a number of different areas. Because of savings, on the next slide, we'll see that, the largest benefactor of spending is going to be the consumer discretionary sector. This sector covers, basically every industry that produces a good has some exposure here. Some of the bigger names would be Amazon or Home Depot. Some of the smaller names might be, a Midwest home builder. But as spending increases and as we begin to reopen, the strong move that we've seen off the March lows will continue. But at the same time, we expect the sector to begin to broaden out and more participants, not Amazon doing everything or Walmart doing everything. We'll begin to see some of the smaller companies that have been hit because of shutdowns, whether it's the cruise lines, the airlines, traditional brick and mortar stores, restaurants, hotels. There'll be different areas of the economy that will finally improve because of people feeling comfortable to go out and be involved, as well as loosen up that money that they've saved over the last year. The second part, reopening trade factor, is much what Greg already spoke about. It's stimulus. Stimulus is going to be coming again in a big way. On top of that, we are going to be having spending, which we have not had massive spending on infrastructure in forever. It does look like it will get passed. It will be a very large bill that will have to be paid back at some time. But the stimulus, on top of everything else, on top of all the savings, and on top of all the tax benefits that we've gotten over the past year, there's a lot of money that's going to continue to come in to the economy. On the next slide, again, it's much of what Greg already talked about with interest rates staying near zero. The Fed will continue to support the market through their quantitative easing program at $100 billion a month. That may change, but for now, they stated in their most recent meeting, they expect that to continue on through the end of the year. To put that size of quantitative easing or bond buying each month in perspective, think back to the initial round of QE that we had coming out of the Great Recession. We were usually in 75 to 85 billion a month at that time. So we're significantly higher, and we've been significantly higher since March. If we are going to get the spending and the additional stimulus, the major benefactor is infrastructure, which again, there's not been infrastructure spending in this country in forever. No party wants to put blood on their hands, but at this point in time, it's easy to get the spending through as part of different COVID relief bills. So we would expect the industrials and materials to benefit the most, as well as a push for renewable energy, which we'll talk about later. But frankly said, infrastructure spending will help out just about every single sector in the market. This is another example of what you get with lower interest rates, which equate to lower mortgage rates. So we've seen, through all the turmoil last year, continued price increases within the housing market here in the US. And I mean, up 10% last year, well above where we were the previous year. And things continue to roll along in a positive sense. Housing starts were up almost 6% in December. Building permits were up 4.5%. Single unit starts surged 12%. Single unit permits were up almost 8%. I mean, the demand still remains excessively strong in the housing market. And it's going to take a fair amount of increase in interest rates to put pressure on mortgage rates to kind of slow down the housing market. But for now, the home builders, the home improvement sectors just continue to benefit from lack of supply, low inventories, greater demand. We are seeing some shifts in states of domicile. A lot of people moving from New York to other states. We're getting an influx of people down here in Florida. So there's going to be potential hotspots that are going to pop up from time to time. Also, there's a potential tax credit that's going to be on the books underneath some of Biden's proposals. That would be a $15,000 tax credit for first-time home buyers. Again, as we get into this later, talking about taxes, it's going to be interesting to see what happens. Productivity, and it's insane when you look at the labor statistics, how strong our third quarter labor productivity was, even with lockdowns still being in place and the economy not, even close to full speed or full capacity. Set record in both output and hours worked in the third quarter. We're still below the 2019 levels, but we're closing in on those quickly. We may get those when the fourth quarter data is released, but productivity is much stronger than expected. And this is really a technology issue. And one of the reasons why we still like tech, products like Zoom and DocuSign, Blackline, these different products, that software that allow you to work from home and still be productive away from the office, really allowed the productivity numbers to remain strong. And because of the strength, we see that there's going to be no issue going forward when we do reopen, that there'll be any disruption in hours worked and output, because we expect the demands to continue throughout the economy as things normalize. And the fact that productivity there is just one of those things that you still want to sit there and scratch your head when it comes to 2020. Again, technology, the progress that we've seen in technology was a critical factor in allowing, labor force production to rebound so quickly. As Greg said, we're in a multi-year phase with the expansion of technology. Doesn't mean the leaders today are going to be the leaders 10 years from now, but things will continue to grow on top of each other. I mean, a decade ago, we all wouldn't really know what the cloud was or the Internet of Things. Connectivity is becoming a bigger issue. And, the strength in technology will continue to drive the gains that we see in individual productivity. And at the same time, will change some different aspects to our working careers, such as not as many people going to office spaces. Along with productivity, one of the other major strong points that most people don't realize has been the global environment, for the manufacturing sector. China, basically, as we put on here, is the lowest common denominator in the global supply chain. Now, think of it however you want, but China has controlled the virus quicker and better than most countries. The strength in their global supply chain as the common denominator allowed manufacturing to remain very strong. Global PMI, Purchasing Manager Index, has rebounded to post multi-year highs at this point in time, which is another head scratcher. So looking at manufacturing and what I'd call two-front war is something we don't have to fight. Manufacturing's there. Now the reopening has to deal with the service industry and getting our services back up to full speed. Seeing that China has benefited the most from the manufacturing aspect, and that it's a trend that's going to continue. The Chinese market still looks very, very interesting. We added some exposure to China a number of months back in our growth ETF model. And we think China is going to be somewhat of a leader for the rest of the global market. Now, taking into account everything that we've thrown at this market, everything that we've saved to spend in this market, and certain areas that have remained very strong, even though we have stimulated as much as we have, we've got to expect robust growth this year and maybe into next year. So we're going to start to see a little upward pressure on inflation. It's not going to be anything runaway at this point because the Fed will remain very accommodative. And at the same time, the way the government constructs inflation is much different than what you and I think of. So there is a large amount of housing based into their data, which a lot of that housing consists of the rental market, which we know where the rental market has been because of the COVID-19 shutdowns. So we should expect to see maybe the largest increase in inflation we've seen in a long time, but it's not going to be anything that's going to run away from us. One area that would benefit from this inflation would be the financial sector. I mean, inflation and rising rates, interest rates provide them with some net interest margin, something that they have not had for much of the last decade or so. Strength in the financial sector would be outstanding because it makes up so much of the marketplace, as well as continued strength there and continued growth increases their ability to generate loans and offer assistance, will just continue to build out the rebound and the reopening of the market and the economy going forward. Another factor with inflation is precious metals and commodities. If we do see increased inflation more than anticipated, at least this year, gold remains a very effective hedge because we expect the amount of stimulus that has taken place that we're going to see the US dollar pull back, and most commodities are inversely correlated to the dollar. So a weaker dollar policy bodes well for most commodities. Strength in manufacturing and the global market reopening and the potential for massive amounts of infrastructure spending will help out many of the industrial metals, for example, silver, which we think has a great opportunity to outperform going forward as well. The only concern on commodities that is unknown is oil. Oil is in the crosshairs of this administration. There's going to be a number of different restrictions or regulations placed on oil and taxes as a way to help build out the renewable energy sector. But on top of that, the main thing with oil that you have to keep an eye on is how is the OPEC plus consortium getting along? This is mainly Saudi Arabia and Russia and their price controls and production levels. If you go back to the March market when when Greg showed that chart earlier of us falling 34% from late February to late March, a fair amount of that was coronavirus shutdowns, but we really got that second big leg down due to a big disagreement in pricing and output levels between Saudi Arabia and Russia over the weekend of March 6th. It wasn't until they came to the table too a couple weeks later to become friendly again that helped firmed up the market. So oil prices are going to be all over the place going forward. So, looking at what, our theme is going forward as we get into this reopening trade, is just maximum flexibility. And this is going to be something that's going to take place, a theme that we'll have for the next couple years, because we're in an area where the market can move one way or another in a short amount of time. We're not going to bore you with all the data that we keep, but the basic market internals that we look at are some of the strongest that we've seen in over a decade. And what's interesting is when you look at some of these indicators, they typically happen at the start of up moves, the start of major multi-year uptrends. So what I have here is a chart of the number of stocks in the S&P that are above their 150-day moving average. What's interesting is we're back to an initial level that we saw coming out of the lows in 2009 and coming out of the lows in 2003. And in both cases, we had exceptional outperformance within the market over the next 4 years with very, very limited downside risk. There's maybe 10 or 11 different indicators like this that we have that are all saying the same thing. So although we've run really hot the last year, there's still a number of things that look very positive to us from a historical reference. I know Greg talked about it earlier, and it's one of the key investment themes for myself when we're looking at portfolios, and really the main driver for the market over the last decade. It's all about liquidity. It's all about the stimulus measures that are in place, how accommodated the Fed is being, and how much money is in the market and how much that money wants to be invested. What we have here is some data we keep every night, and then the blue line is just accumulated average of the high yield bond advanced decline line. So we calculate the number of high yield bonds up versus down every day, and then we accumulate that to give us a trend, as well as I put a 5% moving trend on this indicator. I lay the S&P behind it just to see if we find any divergences. This high yield bond advanced decline line made an all-time high yesterday. We're seeing the same thing in different breadth readings too with the major indexes. So we keep a close eye on the high yield bond line simply because it's going to be most sensitive to liquidity. Looking at our new administration, history shows us that when a Democrat takes the White House from a Republican, the first year of the presidency usually produces some outstanding returns. In this case, 17% since 1929. We do have the opportunity to see some market weakness in February, which seems to be the weakest month for the first year term. But other than that, we have continued growth after the first quarter on a seasonality basis. So we have a couple themes here for 2021. Obviously, the first thing is that we still believe in the tech sector as being a market leader because of the structural changes in place from the COVID shutdowns that aren't going to ever revert back to previous norms. Valuations are stretched in certain areas, but again, if liquidity is strong, fundamentals mean less. An interesting spot on technology is how things change and adapt. We still think the semi space is going to be very strong this year. And interesting enough, one of the areas that is seeing a shortage in semiconductors is the auto space, because of all the connectivity and the basic electronics inside of cars. Toyota had to shut down production for a couple of days because there wasn't enough semiconductor capacity for their vehicles. So next is renewable energy. Climate change, we already know, is going to be a big narrative under the Biden administration. Increased regulations and taxes on fossil fuels will help raise their costs to make renewable energy look more affordable, as well as help fund renewable energy subsidies. It's a great idea. It's just not going to be something that's going to happen overnight. But there's going to be a much larger push that should lead to some more commonplace changes in the structure of our energy system. Healthcare minus the pharmaceuticals. I say minus the pharmaceuticals because we know both political parties love to complain about drug prices all the time, even though not much ever gets done. Healthcare will continue to improve due to the massive amount of spending on COVID relief, money for hospitals, nursing homes, the vaccine, as well as the simple fact that under Democratic leadership, we do see expansion in Medicaid coverage and Medicare reimbursements. Large-scale infrastructure package, again, huge for the entire market, most notably the industrial material space, where we've seen a lot of individual stocks move out of longer-term bear markets. With the expanded valuations of growth stocks at this time, we have begun to see a large broadening of the overall market, such as the financials, which have improved significantly the last 3 months. It's a tough call, but we're finally beginning to believe that we're going to start to see more of a move away from growth into value and dividend names, high quality earnings, the boring companies like Kroger that have sat there for years. Their valuations are much more acceptable at this time, and they should begin to start to see some benefit as far as the reopening trade, because they're so tied into the service sector. Marijuana and gambling are going to be two themes you'll hear a lot about the first half of the year, because they're tax generators, and a number of states are looking for ways to close the tax bill issues that they've had because of the shutdowns. The interesting thing with looking at marijuana or cannabis as an investment, it's a great idea, and it's something that's going to become more of a mainstream product here in the US going forward. It's a simple fact, though, that there's still too much productivity. There's too much production of the actual product that outweighs consumption. So there's lack of pricing powers. It's a nice trade. There'll be some companies that win, but it's not a trade that doesn't have a lot of risk to it. And finally, the reopening market will lead to some of the benefactors of the lockdowns underperforming going forward, and hopefully will allow the names that have underperformed and have been hurt the most from the lockdowns to rebound as things reopen. The traditional brick and mortar stores, cruise lines, airlines, hotels, restaurants, anything really service related should finally be able to get a boost to their asset values.
So we're going to wrap up right here just because we're running out of time. Guys, if we can help you out, let us know. We're always happy to help. We want you to make money, and we want to help you out as much as we can. So.